Today, we're reviewing audit engagements and auditor responsibilities. There's a lot in this topic, so we're breaking it into 6 parts. Let's get started. Part 1. Understanding the audit engagement. The purpose of a financial statement audit is to increase users' confidence in the financial statements. Management prepares the financial statements while the auditor independently evaluates them, gathers evidence, and expresses an opinion about whether they are fairly presented in all material respects under the applicable financial reporting framework. Think of the audit process in 5 stages: accept, plan, test, conclude, and report. First, the auditor determines whether to accept or continue the engagement. This includes considering ethical requirements, especially independence, and establishing an understanding with management. Next comes planning and risk assessment. The auditor learns about the client, its business, industry, environment, and relevant internal controls. The auditor establishes materiality, identifies risks of material misstatement, and designs procedures that respond to those risks. Think, understand the client, find the risks, and design the audit around those risks. During testing, the auditor performs procedures and obtains evidence. Tests of controls evaluate the operating effectiveness of relevant controls when the audit approach requires evidence about control effectiveness. Substantive procedures are designed to detect material misstatements in transactions, balances, and disclosures. The auditor then evaluates the results, reaches conclusions, and communicates those conclusions through the auditor's report. That covers the overall process. Now let's move into part 2, management versus auditor responsibilities. Management is responsible for 3 major things. Remember PIA. P means prepare and fairly present the financial statements under the applicable reporting framework. I means establish and maintain relevant internal control. A means give the auditor access to necessary records, information, and people. The auditor's responsibility is different. The auditor obtains reasonable assurance about whether the financial statements are free of material misstatement, whether caused by error or fraud, and expresses an opinion based on the evidence obtained. Here's an exam trap. The auditor does not take responsibility for the financial statements, and the auditor does not establish management's internal controls. Those belong to management. Now let's move into part 3, the auditor's mindset. Professional skepticism means maintaining a questioning mind and critically evaluating audit evidence. The auditor stays alert for unreliable information, conflicting evidence, possible fraud, and circumstances requiring additional procedures. But professional skepticism does not mean assuming management is dishonest. It also doesn't mean automatically assuming management is honest. The auditor remains objective and follows the evidence. For example, if management says, "That receivable is collectible because we've worked with this customer for years," the auditor shouldn't immediately assume management is lying, but shouldn't simply accept the statement either. The auditor needs evidence. Auditors also need to watch for bias, overconfidence, familiarity with long-term clients, and pressure from deadlines or heavy workloads. Past experience with an honest client does not replace current period evidence. Independence is also essential. Independence, in fact, means the auditor is actually objective and unbiased. Independence in appearance asks whether a reasonable outside observer would perceive the auditor as independent. An auditor can believe they're unbiased and still have an independence problem if the circumstances make their objectivity appear compromised. Now let's move into part 4, professional judgment and audit evidence. Professional judgment means applying relevant training, knowledge, and experience to make informed decisions based on the facts and circumstances. Auditors use judgment when determining materiality, assessing risk, selecting procedures, evaluating estimates, determining whether enough evidence has been obtained, and reaching conclusions. Here's an easy distinction. Professional skepticism asks, "Should I question this?" Professional judgment asks, "What should I decide or do?" Now remember 2 very important words: sufficient and appropriate. Sufficiency relates to quantity. How much evidence do we have? Appropriateness relates to quality, including relevance and reliability. So remember, sufficient equals quantity, appropriate equals quality. More evidence does not automatically mean better evidence. A large amount of poor quality evidence does not necessarily compensate for evidence that isn't relevant or reliable. The auditor needs sufficient appropriate audit evidence. That covers evidence. Now let's move into part 5, reasonable assurance and inherent limitations. An audit provides reasonable assurance, not absolute assurance. Reasonable assurance is a high level of assurance, but it is not a guarantee that every material misstatement will be detected. Why? Because audits have inherent limitations. First, financial reporting involves judgment. Estimates such as credit losses, fair values, useful lives, and contingencies involve uncertainty. Second, audit procedures have limitations. Auditors may use sampling rather than examining every transaction. Fraud can be deliberately concealed, and audit evidence may be persuasive rather than conclusive. Third, auditors face practical limits involving time and cost. Instead of investigating everything, they focus their work on areas with greater risk of material misstatement and perform procedures designed to reduce audit risk to an appropriately low level. The takeaway is simple. Reasonable assurance means high assurance, not guaranteed assurance. Now let's move into part 6, nature, scope, and types of audit engagements. The auditor must understand what the engagement actually covers. It may involve one period or multiple periods, an entire set of financial statements, or, when appropriate, specific statements, accounts, or elements. For non-issuers, an audit isn't the only possible service. Depending on the client's needs, a CPA may perform a preparation, compilation, review, or audit. Don't automatically assume every CPA engagement is an audit. Now let's distinguish a financial statement audit from an audit of internal control over financial reporting, or ICFR. A financial statement audit focuses on whether the financial statements are free of material misstatement and fairly presented in all material respects under the applicable reporting framework. An ICFR audit focuses on the effectiveness of internal control over financial reporting and whether material weaknesses exist. A material weakness is a serious control deficiency or a combination of deficiencies that creates a reasonable possibility that a material misstatement will not be prevented or detected and corrected on a timely basis. When the financial statement audit and ICFR audit are performed together, that's an integrated audit. The auditor is evaluating two different things and may express two opinions, one on the financial statements and one on the effectiveness of internal control. Here's an important exam trap. Fairly presented financial statements do not automatically mean internal control is effective. A company can have fairly presented financial statements and still have a material weakness in internal control. Certain employee benefit plan audits under ERISA have additional requirements, but for now, remember that the procedures and reporting requirements depend on the type and scope of the engagement. We've covered all 6 parts, so let's finish with a rapid review. The audit process is accept, plan, test, conclude, report. For management responsibilities, remember PIA, prepare the financial statements, internal control. Access to information and people. Professional skepticism means question and critically evaluate. Professional judgment means to decide based on the circumstances. Sufficient means quantity. Appropriate means quality. Reasonable assurance means high assurance, not absolute assurance. A financial statement audit focuses on the financial statements. An ICFR audit focuses on internal control. When both are performed together, think integrated audit. And remember the responsibility trap. Management prepares the financial statements and maintains internal control. The auditor independently evaluates, obtains sufficient appropriate evidence, reaches conclusions, and expresses an opinion. That's your audit quick review. Thank you for listening.